live from the city. This is the High Valuation Code with Matteo Turi.
Now.
And a very welcome to everybody to episode number 12 of the High Valuation Code. And today we are in group 4. If you want to imagine, we have 4 groups, and today we are in group 4. Yeah, last week we spoke about exit. Today we are going to talk about valuation. And last week, I think that we say something that made a lot of people uncomfortable, unfortunately, but this is kind of a reality check because we are explaining what are the realities that actually the companies face when they try to exit, particularly in this group where we are talking about exits, valuations, and the deal capture. So as a small recap from last week, the exit is already decided. Now, not when you sell really, but in how the business is built, right? So this is a process that starts many years, sometimes before the actual go-to-market is proposed or launched. So that matters because the exit value is not built for one final negotiation. It's built on the structure that a buyer believes can survive without the founder, right? So you have to think on the other side of the equation. So what the buyer are looking for, so you have to build towards that. And many people think, I say, well, that's not my job, this is my company, etc. But then with that thinking, unfortunately, is where you start to get all the frustrations, all the back and forwards, and they say, why they're asking me this, why they need all these things, because actually, effectively, there is a mechanism, a system to acquire companies. And the key here is the buyer believes that if the company can survive without the founder. So today, digging deeper into the group 4, which is exit, valuation, and deal capture, we are going to go further because even when two businesses look similar, that actually this happened many times. So you might think it's similar revenue, similar industry, similar growth. They don't get the same valuation. We provide several examples already in the past weeks. So one business might get a 3 multiple of their EBITDA. Another gets a 12-fold or 12 multiple of their EBITDA. So what is different? We know that it's not a lucky strike of a company. It's all about timing. It's about the performance. So it's a lot of things that we have to unpack today, and I think it's a very exciting opportunity because all these things come to 3 things. So it's not a platter of things that you have to consider. If you start to consider these 3 things, you're going to find out that actually your multiples start to get more attractive for your valuation. And these 3 things are scarcity, optionality, and trust. And talking about trust, we have obviously the book today, right? Fail, pivot, and scale. But why I'm presenting the book again today so early? Because in the introduction pages on page 12 and 13, we already have the high valuation triangle that actually provide this kind of the structure that you're looking for. So it's the IP monetization, the succession planning, and the scalability. So in terms of IP monetization, that creates a scarcity because actually is that your intellectual property. In terms of scalability, that creates the optionality. And then in succession planning, that creates a trust, right? So that is why 2 businesses with a similar numbers can receive different valuations. And so welcome, Matteo. It's a long introduction, but I think it's very good to do a recap of what we are talking about. We are getting the very exciting portion where there is a lot of value to untap here. So in these 2 businesses, the one get 3 fold or 3 multiples and the other one get 12. What is the gap in the middle of these 2 different valuations?
Thank you so much, Francisco. Well, yeah, this is where I always say we as finance professionals, we need to absolutely understand that the world has changed. We live in an intangible economy, and so financial statement will never tell you anything really interesting about the the value of the business. Yeah. Why am I saying this? Because buyers, in any case, they never price businesses. Yeah.
No.
What do they price instead? What they really price is outcome. Yeah.
Right.
And the price outcome and two companies can generate the same EBITDA, but represent completely different future. Okay, so because the investor, when they obviously put the money, when somebody buy a business, they will buy because they expect a future outcome. Yeah, they don't
Right.
they don't just look back; they look forward. Yeah.
Yeah.
This is why the high valuation triangle wants to really give an answer to the three question. Question number one, what do you own? Question
Yeah.
number two, how does it transfer value? Question number three, how does it scale? So
Right.
just looking back at the two companies, they can generate the same EBITDA,
Yeah.
but represent completely different futures. One
Right.
looks fragile,
Right.
the other looks inevitable because the answer to this question is so much better, and that's where the multiple changes. Yeah.
Right. So, what is so? This is not just about numbers, then.
No, it's not just it's absolutely. That's why I'm saying the really the function of finance professional,
Right.
it should absolutely not be to report the past, but really you have to design the future effectively. Because if you
Right.
do not design, as we said last week, yeah, it's about we're thinking about well, the exit value is something that you decide when you negotiate. You don't
Right.
decide anything when you negotiate. Unfortunately, it's all about what you've done before when you design the value of your business. So
Right.
it's about how those numbers are interpreted. Yeah. So a buyer
Yeah.
will look at your business and will ask a number of questions. Now, one question is how repeatable is this?
Right.
They don't look at what you've done in the past. They look how you can continue to repeat what you've done in the past.
Right. Right.
The other question is how scalable is this? What does scalability means? It means more and more better result, higher profits, higher cash flow with less effort. Yeah.
Right.
So that's where you usually go back to your intellectual property.
Yeah.
How transferable is this? Again, the question that is answered by the high valuation triangle.
Right. Right.
Also, they measure how risky is this because there's always this not changeable equation, not
Yeah.
negotiable. When risk goes up, valuation goes down,
Yeah.
and the other way around. When risk goes down, the valuation goes up. So
Right.
the more you're able to anticipate and remove the risk before you speak to an investor and to a buyer, the better positioned you are when you actually have to do the transaction.
Yeah.
Then it's also about optionality, yeah.
Yeah.
Is the business does it have lots of optionality or lots of dependency? So how
Right.
many option does this create?
Yeah.
And based on those answer, they then decide the multiple. So
Right.
as you can see, none of this is written on a financial statement, on
Yeah.
a profit and loss account, or a balance sheet either.
Yeah, no, I think it's brilliant because but probably I'm going to ask you a few questions to the audience now because actually I think I think it's a right moment to pause and think about these things because but some people might think, I say, but that's not my job. But effectively, if any services, any products, any market activity requires to sell something, so your company now is what you're selling. So you have to prepare, the same as you're selling your products or your services, you have to prepare to sell that. So the questions I would like to pose now and ask the question. So if your business went to market today, so let's imagine this for a second. So I say, okay, I decided to sell my company. So this would be the questions. Would buyers see what would the buyer see? Is a predictable business? Is a scalable business? Is a transferable business, meaning that you have all the things ready to leave and people can continue doing as good or better than you? or is a fragile business? So if you can think about these things, I repeat it again. So is predictability one, scalability second, third is transferability, or fragile. So because that perception drives your multiples. So I give you a second you can make a scribble, jot down what you think is your business today, and we'll continue with the conversation with Matteo. So again, the questions are predictability, scalable, transferable, or fragile. And this is not to judge anybody. It's just to start to make an idea where you're standing today based on your business. So what about if we break these questions down, Matteo? We go one by one and we explain what is this. So probably if some people are lost and say, well, what is this about? We can explain what is each one of these points. So what about scarcity? What does actually mean in evaluation, scarcity?
Yeah, interesting about the question you posed to the audience, because many people they will find the answer themselves, predictability, scalability, transferability, or fragility. But let me come back to your question about scarcity.
Yeah.
Now, scarcity, what does it really mean? It means that you are not easily replaceable.
Right.
It means your business is something others do not. Yeah.
Right.
So that could be, for example, proprietary intellectual property.
Right.
And we're talking about commercial intellectual property. We're not talking about legal intellectual property, because
Right.
many people think that intellectual property is just the document in your box,
Yeah.
in your email or whatever. So you're talking about really commercial intellectual property. The other reason for scarcity could be unique positioning. You're uniquely positioned in the market for what you do. Or I would even say more a dominant niche. Yeah,
Right.
a dominant niche. You don't just dominate one day, you dominate for more than one day.
Right. Right.
Um, it could be a differentiated model. Okay. Um, why am I making this list? Because if a buyer has many alternatives, you got a lower multiple. Okay.
Right. Right.
So if a buyer says, okay, well, I know another business that has a similar
Yeah.
situation like yours, then obviously, the multiple gets lower.
Right.
The more special, the more scarcity you can show, the higher the multiple.
Right.
If they feel that they might lose the opportunity, you get a premium instead.
Right.
So that's where they say, well, really, this business, you're not going to find this characteristic in too many other businesses. Then you get a premium.
Right. Excellent. So I hope this start to map out the questions that we ask, and you can compare your answer with this response or this structure that Matteo just put together. So and the second one was optionality. When you mention optionality, or when we ask optionality, how we break down optionality?
Optionality, what an important word, yeah. Now,
Yeah.
optionality is, I would define it as what the buyer can do next.
Right.
Okay. Uh, Example, can they scale it? Uh, can they expand it?
Right.
Can they integrate it? Can they extract more value from it?
Right.
So a business with just one path forward is limited. A
Right.
business with multiple growth paths becomes strategic.
Right.
Um,
Right.
and strategic assets command high multiple.
Yeah. Yeah, no, that's very interesting, because now you have two things actually where you see how you see your company. So what do you have that is proprietary to your company that actually nobody else have in the market? And then you have the second leg in with optionality to say how the next or the acquirer can grow in different directions based on the foundation that you have today as a company, right?
Yeah.
And that increases the valuation because actually the capacity to do more with the same acquisition. And in the third thing that we ask is the institutional trust. So
Okay.
how would you mention or how you describe the in institutional trust?
Institutional trust, yeah.
Yeah,
I mean, first of all, I would say many finance professionals will have understood that none of this comes from any financial statement, you know. So that's what
right.
I was saying before. So let's talk about institutional trust now. This is
Yeah,
one of the most founders underestimate, really. Trust is really built through a structure. So
right,
clear financials, documented processes, strong governance. You know, many people say, "Oh, governance when it's the right time." Well,
right,
actually, the longer you wait, the more you're gonna leak value. Also, visible risk management and independent leadership. Okay,
right,
because when a buyer trusts the system, they pay more
right, right,
because they're gonna buy into the system. But when they don't, they discount, of course. Yeah.
right. Yeah, and it's useful to clarify that when we talk about systems, it's not necessarily software because many people say, yeah, we are digital, we are digitized, or we brought our company with ERPs or accounting software, etc. But actually, the systems is all the other things are related to that, like workflows, operational activities, how it's documented. All the things are put together in terms of how you process and deliver things from the raw material to collection, right? So just be careful with this distinction. It's not digital systems. It's about the processes and activities that you follow in a certain sequence to produce your services or products. And I think that now, one thing actually I want to bring back, because actually that reminds me exactly again the book, the Fair Pivot Scale book that is in Amazon available now. They start to get brilliant reviews with people that are reading. Actually, we have last week a conversation with a consulting firm in Canada, and one of the partners bought the book in Canada, and he was very surprised because you can imagine a consulting firm buying a book like this. They've seen many books in their lives, and they were shocked of the quality and how practical the book is in terms of looking to read the information and applying to the business. But I think it's relevant to this conversation today is this particular point that I want to mention. I bookmarked it when we were preparing for the call today, which is the bonus chapter number 6. I don't know if you can see that right in my screen, which is the page 317. So the three sides of the triangle, or the high valuation triangle, and how to make it unstoppable valuation, right? So this is very important for our conversations today, because then it's not about theory here. It's a practical manual to step and to follow into how you can apply it to your company, or at least to think about how your company is structured in terms of if you're looking to exit or a share value, how to increase the valuation. So I think that we mentioned before we pause here, I think it probably will be interesting to introduce the teaser of the book too, Matteo, if you're happy with that, because after that I would like to look into these things that we mentioned at the beginning. There are two companies with the same profit, but can be a complete different feel for the buyer.
Oh, thank you. Well, Francisco, we can go ahead with this 90 seconds to present the book. And yeah, let's go back into the subject matter after these 90 seconds. Thank you very much,
Fantastic,
everyone.
excellent. Right, excellent. So before the teaser of the book, we mentioned the two companies, as we mentioned at the beginning. One will have a 3x valuation, the other one will have a 12x valuation. So can feel completely different to a buyer, Matteo. So how that happen?
Yeah, I want to go back to what I said before, really.
Right,
Um, People tend to just look at financial statement and say
right,
immediately come up with a value for the business. Uh, Unfortunately, this is where financial statements are really useless. That's why it's very important that especially finance professional, you're listening,
yeah,
understand how significant this is. Yeah, uh, you look at a financial statement, profit and loss account, even the last few years, the balance sheet. You will not be able to say what the business is worth.
right,
And what we were saying before, we were talking about what you detect in terms of scarcity, what you
right,
determine in terms of optionality.
right,
So what you determines in scalability, obviously, that's something that you can only find out well beyond the financial statement. So
right,
because one company that is actually has got a low multiple will feel like effort,
right,
okay? Uh, the other one will feel very different. It
right,
will feel like an asset,
right.
and buyers will pay for the assets,
Yeah,
not the effort. And sometimes the assets they're not according to current accounting standards. You will not find those assets on the financial statement, or you may find them if the company has done a certain type of accounting policies, but usually you don't see them, which is why it's so important that we finance professional understand this a little bit more. Yeah.
right, right. So I think actually the questions now if you want to jot these questions down and compare it to your company, what I would say, what is currently limiting your valuation the most at this point is scarcity, and we already discussed this, optionality or trust, right? So do you have something actually the market doesn't have in terms of scarcity, yes or no? And then you can list things actually what make you a company unique or actually that is valuable to an investor. What optionalities you have today in terms of once the acquirer goes to the market, what other avenues of revenue streams they could produce based on your organization. And we mentioned already trust and how you build this trust to be acquired or to have a higher valuation. So I think that these are very good questions because then you start to think about, I say, where you are today, what you need to do, where you want to get, and then you find that gap, right? So let me ask this, Matteo, because I think it's very important because we mentioned this a few times, but probably we can go in practicalities, if you may. So if somebody wants to move from a three um, 3x would be the evaluation to a 6x, right? So this is multiples, or even from 6 to 12. So what actually needs to change?
Yeah, you're asking the question about how do you potentially even double your valuation, yeah?
Yeah, exactly.
Yeah,
Yeah,
potentially double. It was from 3 to X to 6 to X, yeah. From 3X to 6X or from 6X to 12X.
yeah,
Yeah, we're talking about really a big difference here. So we're doubling the valuation. We are multiplying your valuation by twice, by two.
yeah.
Um, Okay, I can tell you about three things that will make your valuation go up 100%, double.
Right. Yeah,
We're talking about obviously common practice, common valuation we see around the corner. Yeah. So the
right,
first thing will be when the revenue becomes more predictable.
right.
Okay. So we've been speaking over the last few weeks about intellectual property as a dynamic
Yeah,
mode as opposed to a static mode, yeah,
yeah,
where you use your intellectual property to standardize your revenue to make them more repeatable. So first, revenue becomes more predictable.
Yeah.
Second, dependency reduces. I know this is such an important subject in the book as well.
Yeah.
You don't see this again on a balance sheet, on a profit and loss account. You see this when you understand if a revenue depends on a founder as opposed to someone else,
Right.
or a choice of a supplier depends on the founder and no one else.
Yeah.
So
Yeah.
dependency reduces. The other thing that will double the valuation together with the other two is when risk becomes visible and managed. Okay. Now, many founders, they will say, oh my God, I don't want to hear anymore about risk, because
Yeah.
I'm getting bored about risk.
Yeah.
Risk is asymmetric, What you need to do is risk is about protecting your downside
Right.
as well as maximizing your upside.
Yeah.
When those three things improve, then buyers feel confident,
Right.
and confidence increases the multiple.
Right.
Again, not something that you suddenly have. You don't suddenly become less dependent on the founder. You do not suddenly make your revenues more predictable.
Yeah.
You do not suddenly make your risk more visible and managed. You design these things, you engineer them, and by the time you are in front of a buyer, you have them.
Right. And actually, I think the key word here is, by the way, I repeat these steps because I think they're brilliant. Because how you measure trust, and I think actually you just gave the code here, where which is the revenue becomes predictable, dependency reductions, and risk managed, right? So I think that is brilliant because actually the key word that I wanted to rescue or to keep present all the time is the word design. So it's something that you design with your company towards an exit and to evaluation, and it's something that we mentioned last week, which is the revenue quality too. So if we come touch back into the last week revenue to quality, what you will say, Matteo, on those points to build trust and everything else?
Yes, revenue quality is up there really. It's one of the
Right.
biggest driver.
Right.
One of the biggest driver. I mean, if people recall listening to us a few weeks ago, we went into details about this.
Yeah.
So when does the revenue possess high quality? I would say let's talk about four type of revenue. Number
Right.
one, recurring revenue. Okay, so it repeats itself.
Yeah.
Number two is contracted revenue.
Right.
So it's enforceable by a contract.
Right.
Number three is diversified revenue. Okay. When you go several streams, you don't just sell a particular solution in a particular situation, diversified revenues. And the last one, number four, I would say transferable revenue.
Right.
Um, Now, when you think about all these four, recurring, contracted, diversified, and transferable, you can see the link to the intellectual property.
Yeah.
That's how really you set up your business. Um, Now, why the quality of the revenue is high when you got these four characteristics
Right.
is because they reduce uncertainty. They
Right.
reduce uncertainty. That's what investors, that's what people will buy for. When you
Yeah.
reduce uncertainty, you increase the price, yeah?
Yeah.
And uncertainty, really, when it's there, it's actually what reduces valuation.
Right. Right. It's brilliant because actually so many times this question is asked, and take and just says a pie in it's a pie chart. They say, oh, this is our recurring revenue, contract, etc., etc. But actually, people doesn't understand the depth that this can go and the implication of that depth. And many times I have not seen this kind of a structure of splitting the revenue by their origin. And the investor have to ask, and this is start when they start to see, well, this business doesn't look well managed. It's not because it's not well managed. It means actually people doesn't have the capacity to build that trust and say, no, we have the capacity to understand where the quality of this revenue is coming from. So when this is, I think, is a question that buyers are not asking, how good is your business, right, Matteo?
Yeah, when somebody is asking how good is your business, let's codify what they're actually asking for. Yeah.
Right.
They're asking really, how safe is this outcome?
Right.
Okay, so that qualifies how good is the business. But more importantly, how much upside do I have?
Right.
Because let's not forget, if I'm gonna come and pay $10,000, 10 million in a more realistic scenario,
Right.
$10 million, I want to make sure that I can sell it on for 20, 30 million. Yeah.
Right.
So how much upside do I have is clearly the the question they're asking for.
Yeah.
If the downside is controlled and the upside is clear, then obviously multiples expand. What
Right.
I said before about risk asymmetry, this
Yeah.
is what financial intelligence should always do. Control the downside and clarity about the upside. That's how I will summarize risk asymmetry.
Right. Perfect. And in terms of practicalities, again, where do funders go, or where do funders go wrong in at this stage? Where they make the mistakes that we can highlight to them and say, listen, if you look into this, your wrong side or your risk, no, I wouldn't say risk, but I said, this is where you go wrong. Look into or think about this, how you can amend this in a way or how.
Mm. Well, we see this everywhere, especially here on LinkedIn, but everywhere on YouTube, everywhere.
Yeah.
The problem is that they focus on growth alone.
Right.
Everyone is talking about growth, yeah.
Yeah.
They chase revenue, they push harder, but they don't build a structure. I
Right.
mean, I've
Right.
been saying this since 2017 when I created the program for the university. Um, you sacrifice the initial margin because you build the structure, and that structure will pay you many, many times over. So
Right.
what happens normally in this situation when they don't build the structure and they just chase revenue?
Right.
What happens? Revenue increases, but what happens with the revenue increasing? Unfortunately, also the risk is increases with the revenue.
Yeah.
And when risk increases, multiples do not expand, and we've seen it. Risk goes up, valuation
Yeah.
goes down. That's
Right.
mathematics. Yeah.
Yeah. And actually, I think that this is a very, very important point, because sometimes people uh, confuse what is growth and scaling. And you mentioned already what scaling. Scaling is actually higher revenues with a similar cost efficiencies, etc., in the organization. But when they go to growth, they go for higher revenues, but actually associated with that, it goes raising capital, more personnel, more friction in the companies, etc. So that is seems to be a distinction that have to be considered every single time before raising capital, or when you're thinking, are you growing or are you scaling your company? So, and I think that the answer is, when you're growing without a structure, that doesn't, what you mentioned, it doesn't create valuation, because actually the only thing that it's doing is amplifying towards something, and people think that higher revenue means actually higher valuation, but it doesn't. If it's not supported by infrastructure that later can scale, meaning actually higher revenue and start to reduce all these costs and frictions that are underneath, and go towards efficiency and profitability, then your valuation probably won't be as you expect as a founder raising capital as you think about, because this distinction is not well founded as a foundation with the right structure, right?
Yeah, what he says is growth without structure does not create valuation. And in actual fact, contrary to common wisdom, I know many people will want to know why, but that's reality. Growth can actually even destroy the valuation because it creates complexity without control. Effectively, I always say that growth without structure is velocity towards risk.
Right.
So buyers do not pay for complexity. What do they pay for is really clarity.
Right. And how you bring this down to the high valuation triangle, Matteo? So just to simplify all this concept, because it seems to be quite abstract, but you simplify this in 3 points, which is a high valuation triangle.
Yeah, this is what I say. Obviously, since I created this system in 2017, it was always designed to not just to add the 3 layers, but compound 3 layers. Okay.
All right.
So it's not like, you add the A plus B plus C. You actually multiply A per B and then you multiply again per C. So the high valuation triangle directly drives multiple and it compounds really the value of the business. So the intellectual property monetization creates scarcity.
Right.
What we said before about scarcity. So, and clearly that creates a high valuation, Succession planning, which is the second side of the high valuation triangle after intellectual property, will create trust. And trust is, again, something that will push your price higher. Okay.
Yeah.
The first side of the high valuation triangle, which is global markets and scalability as well at the same time, creates optionality. And optionality is what eventually will drive your valuation higher together with trust and scarcity. So I would just listen to scarcity, trust, and optionality, all derived from the high valuation triangle. When all these 3 are aligned, you don't just grow, you completely re-rate the business, you completely transform it. And that's where you really go from good to great. Yeah.
Right. No, I love it, because actually, if you notice that actually in the high valuation triangle, there is no mention the word growth, is the word scalability and global optionalities, right? So this is very interesting, because then the growth will be part of a drag into the high value, but you have the structure how to make that happen. So if you're thinking in growth first, I would suggest stop there and start to look into high valuation first, just to build all the structure, because then you will be able to grow as much as you want instead of the other way around. So in other words, so the multiple, we are saying, Matteo, is not something you negotiate really.
No, absolutely. You don't negotiate it when obviously it's too late. Yeah.
Yeah.
You have to design it. Yeah. And so the multiple is something you earn through structure. Every improvement in predictability that you make obviously is going to be giving you what your result is. You need to improve the predictability, which sounds really counterintuitive for many people. Then every reduction in dependency is the opposite of optionality. So that's really the direction you want to go. And every increase in trust, which is why succession planning is so important.
Yeah.
Every step you take to design your business in this direction moves you up the multiple curve. And this is why we're really inviting all of you to join us in this journey. We are already collaborating with businesses around the world, especially in North America. So we are really creating something also for solopreneur in particular, so freelance professional. Last year, I met with a freelance professional, and we increased the valuation in front of banks and investors from £100,000 to £400,000 because we were able to do these three things.
Right.
Improve the predictability, reduce the dependency, increasing the trust. Now,
Yeah.
you might think valuation is not necessarily your future, but it's your present as well,
Yeah.
because the high valuation triangle will help you to increase your revenue streams as well. The quality of your revenue is not just about selling your business, it's not just about exiting your business, it's about being chased by customer, because when you sell your customer, you don't sell on price, you sell on value. Because don't
Right.
forget this, when you sell on price, you will be beaten by someone else on price sooner or later.
Yeah.
When you sell on value because of your scarcity, uh, the customer will retain you on value. And
Right.
that's what create not just a high valuation business, but it will also create a much more profitable business
Right.
in future. So we will invite you if you want to know more about the various program online. So we got obviously the evaluation sprint as well. You can write sprint and we will send you a a, a scorecard that you will be able to complete. And with
Yeah.
this scorecard, you will be able to understand out of 12 outcomes that your business should actually achieve, or even you as a finance professional, you should have. So we have actually one scorecard for freelance professional and one scorecard for small or medium or large businesses. You tell us which one you would like to receive,
Right.
and we will give you a free diagnostic on your business on these 12 outcomes that will determine how valuable your business is. Okay, so
Right.
again, it's all free, and we'll take the time to go and back and illustrate to you your current situation. So just write sprint or send a direct message to me or Francisco, and I'll be happy to help you.
Yeah. Fantastic. Excellent, Matteo. So I think that we can wrap up this week, number 12, about our topic today. So next week we're going to talk about the final layer of the group 4, where value is actually won or lost, which is the deal structuring, right? So when you go into a situation that you're going to go to structure a deal, because even if you build the right business, the wrong deal can destroy the valuation or the value of your company. So as usual, Matteo, the last wisdoms of words to close the chapter today.
Oh, thank you. Thank you very much for this other session with you, Francisco. I'm really enjoying this weekly live. No, as I was saying before, uh, be aware of the narrative that we see too many times, that you just have to grow. It doesn't really create the future that you want, really. You need to
Right.
create structure, and this is really the big takeaway from today. Uh, yes, you need to grow, but just growth is not enough. Make sure that you create a structure and a system that will allow you to prosper for the long term.
Right. Fantastic. Excellent. Thank you very much. And we regroup next week. Thank you and bye-bye.